savings in gold is definitely what people should do to whatever extent they can, or even silver.
We are now broke, and we are going to war intentionally to distract from our currency problems, our inflation problems, and our political divisions.
Ladies and gentlemen, it's time again for our monthly von Greyerz interview, and this time we have a premiere. I welcome Egon von Greyerz, of course, and Matthew Piepenburg together. Very nice to have you, both of you, for the first time here.
Jan, always a pleasure to speak to you. So thanks for inviting us.
Looking forward to it, Jan.
Me too. Many topics to cover as always. First, we review the current situation, and then, as we discussed it in the past, it seems that really a big game is unfolding. But let me show to our audience some facts first. To show that the consumer in the US is under pressure, we have here the Consumer Sentiment University of Michigan. The University of Michigan consumer sentiment for the US fell for a third straight month to 65.6 in June 24, the lowest since November, from 69.1 in May, etc. Then we have here the credit card debt. What's more alarming is that the cost of carrying this debt has also increased. Credit card APRs went up 30% in an 18-month period, eating away at customers' budgets more than ever before. So the interest clearly is here the problem. Then we have the existing home sales and the new home sales, which are falling down. Here the existing home sales in the US declined 1.9% month over month. And we see it's pretty low here. New home sales similar, but still not that bad. Then I will show to our audience also used cars losing value quickly, and the savings rate is low as most of the time in the US. That was a lot of input. I see no reason why the US economy should recover. Where should it come from? The consumer, as we know it and discussed it, is really crucial for the US economy. I see no reason for optimism. Do you, Matt?
No, I'm very familiar with the University of Michigan's sentiments because I'm from Michigan and went to school in Michigan, but it's really a fascinating convergence of all the things you noted. You have to remember that 70% of GDP is the consumer, and the US consumer, whether he's in Michigan or she's in Ohio or Nevada or Wyoming or Texas, and I talk to a lot of these people all the time. When you think about it, the average consumer credit card debt, the carry cost for insurance, for interest rate is over 22%, which is frankly immoral. That's an unsustainable, unhaltbar number, and it's yet legalized usury. When you throw on the debt costs, when you add to that the inflation, which is completely misreported, and then you throw on state and federal taxes, the average American citizen, between the decline in their purchasing power, the hidden inflation that is misreported, the interest expense on their debt, and their lack of savings, it really is a convergence of all the worst things that could happen. Yet the American narrative is our stock market's at all-time highs. It's also important to know that 90% of stock market wealth is held by the top 10%. The typical all-American, the Joe Six-pack, is not just suffering academically or statistically, but they're suffering in real time. And if you spend time in the United States, just like if you spend time outside of Frankfurt or Munich or Stuttgart, north or south, the average citizen is being robbed by invisible inflation that's misreported, by higher interest rates, by lower salaries and higher costs, and then taxes. So no, it's not an exaggeration. The middle class is getting eclipsed. We call them the working poor now in the US, and that's not an exaggeration. That's a sad reality that has social and political ramifications as well. But kurz gesagt, yeah, it's horrible for the middle class. They are the working poor. They're living month to month. They have no savings. They're being taxed to no end, and it's not going to look better. And the consumer is a very important part of GDP. But the American political force will overlook that, talk about a rising stock market, go deeper into debt, and debase the currency. That's just the reality.
And it's not just the consumer that is in increasing bad shape, also the state, of course. When the consumer suffers, they have to spend more, and more spending obviously goes to the military. And over time, the GDP or the debt to GDP ratio becomes worse. We talked about that in the past, Egon, and as we see here, the ratio now at 122% is worse than after the Second World War. Imagine this as a fact alone. I think there are global shifts underway that are big time undermining the dollar and the dominance of the USA. And this shows us that there is no solution, no way out. But maybe there is a way out, at least not a good one for the holder of money. We come to this later. Any comment on that, Egon? I think there is.
Yes, sir. Yes. Yeah, what is interesting here that, of course, US is not alone here, that there, country after country in the Western world are also seeing GDP, a debt to GDP above 100%. Take the UK, for example. France is a disaster, also at the same levels. There's the famous historian Ferguson, Neil Ferguson. Yeah, but he said that when one's interest on government debt goes above defense costs, which is the case in the US, for example, that is the end of the country, basically. Because if you have to spend more on interest than actually on defending your country, and in the US case, it's not defending the country. They never had to so far. They just attack other countries instead, and waste money on that, sadly. So. And the US is on its way to banana republic. There's no question about it. We see the projections of the budget office, and there's no reduction in the debt, the exponential debt growth. Sadly, as you said, that this will be loaded onto the consumer also, which can't take more burden than they have currently with their high personal borrowings. But the government has to pay for this in one way or another. And interest rates are not going to come down. I mean, they're going to stay at high level, and we are already now seeing the interest cost of over a trillion on their debt, and that's going to grow exponentially too. So the poor consumers, and as I said, it is not just in the US, it's worldwide, and especially Western world, and because that has an effect on trading for the whole world and on commerce, of course. So we're going to see a decline in the world economy coming, I think, very soon, that it was a further burden, of course, to individual countries, and the only remedy for that is more debt from the government's point of view, because that's all they know. So we're going to see higher debts, higher interest rates, and until sadly the music stops, and that too we'll see in the next few years.
Only to add one fact, I also read that the average American has 4 credit cards, and many of them carry a balance. Usually you pay what is owed to the credit card company at the month's end, but many Americans don't. And as Matt mentioned before, the interest rate is over 20%. So they are really hitting a brick wall. And the state is a different situation. They still can sell their bonds, although also this becomes more difficult, which also speaks for a lower dollar and increasing precious metals.
Yeah, of course, they're all tied together, all of these issues, but they all stem from debt. Debt is the key word, and we talk about it because the facts don't change. The debt just gets worse. When you look at the US dollar, the currency is intrinsically tied to debt. There's really 4 factors that are really clear and not sensational anymore. The first is just the debt, the fiscal dominance. When you get to the point, as Egon said, where your interest expense is twice your military budget, it's 1.6 trillion now this year at the current rates. We don't have the GDP and we don't have the tax receipts to pay for it. So we'll issue more IOUs that less of the world wants to buy, and therefore we'll have to print more money to buy our own debt. So that's just a fact. Then you just have the lessons of history. Every bankrupt nation, whether it was a monarchy, a democracy, or an autocracy, whether you go back to ancient Rome, the Ming Dynasty, Yugoslavia, Germany during the Weimar era, Castro to banana republics to Canada and the US today, they will debase their currency to pay their debt. That's just history 101. And when you cross the Rubicon of too much debt, the 100% to 120% debt to GDP, which Japan crossed a long time ago, but they're not the home of the world reserve currency. The US has done that. They've lived longer, but they won't escape the consequences. That's just history. The third key factor that is no longer a sensational headline, but an increasing reality is de-dollarization. When the US and the West in general, but led by the US, the stupidity to weaponize the world reserve currency about a preventable war in the Ukraine to punish Putin, the rest of the world, friendly or unfriendly to the US, decided to not replace the dollar, but just go around the dollar. So de-dollarization isn't a drama, it's a reality. There are more than 50 countries now trading outside the US dollar. And I think the most important place to see this play out, it's very important to the US dollar as well, because when there's less demand for the dollar gets weaker. And when you have to print more money to pay your debt, that's making the dollar more weak. The oil trade is very important. You can spend hours on it, but the bottom line is very simple. Major countries now that don't trust the US because the US sanctioned a major nuclear power, which is a member of the BRICS nations. Well, the BRICS nations are now going around the dollar in the oil trade too. And you can see China needs oil, and who has it? Russia. They'll sell it to China. China will pay for that in yuan. The Russians will take that yuan to buy products in China, most of which were once made in America, now made in China. And then any difference, they'll net settle in physical gold, which they can go on the Shanghai exchange and convert to other BRICS currencies. So again, this is happening faster than even I expected or we expected 2 years ago when we immediately said that the sanctions would result in a weaker dollar. So the combination of debt, the combination of history, de-dollarization, what's happening in the oil trade, and the net settling in gold is obvious. Central banks have been purchasing physical gold at record levels and dumping U.S. Treasury at record levels. Watch what they do, not what they say. Why? Because gold is the new reserve asset. It's a tier 1 asset, even by the BIS. That is more important than an IOU from a broke country like the United States, home of the world reserve currency. These are just the facts on the ground. All of these things, currency and debt, impact the gold price, oil markets, the petrodollar markets. All of this is changing, and all of it points towards a weaker US dollar, which is, whether we like it or not, still the world reserve currency. It won't be replaced, it will be repriced, it will be debased, and gold is just beginning its first chapter towards an historical rise. It's offensichtlich klar.
You gave me many keywords now, Matt, and yes, against what should the dollar devalue? There is no other major currency. It can only devalue against precious metals, gold in particular. And as you just said, the central banks are buying. I have here a statistics from the World Gold Council. That's up to the end of 23. And we have here central bank purchases over 1,000 tons. That's the accumulated amount over years. That's the amount per year. And we see there is a very good uptrend now. It continued also in the first quarter of this year. I will show this here in a little picture. Those are tectonic shifts, Matt, as you said it. And I talked about that with Egon in the past. Also those sanctions, they are really a shot in my own leg. The BRICS countries, they become more and more, they avoid the dollar, they deal among each others in their local currencies. There are shifts underway. We cannot not even imagine what will follow them. And one recent news was, for instance, and a really frightening one for the US, I would say, Turkey wants to join the BRICS. A NATO country wants to join the BRICS. More and more countries, not all strong, of course, join this club. But that means the demand for gold is rising, as you said, and the demand for the dollar is sinking. And this, of course, because we have the biggest military power on this one side, also increases the danger of a big conflict, at least in my opinion. Egon?
Turkey is always trying to ride two horses simultaneously. You know, they're using one against the other when it suits them. It's clever. You know, anyone who would do, because they're strategically placed between Russia and NATO countries. And therefore, you take, for example, the NATO membership of Sweden. You know, Turkey was blocking that, but of course, in the end, we knew they would actually force Turkey to agree to Sweden joining, and they did that easily by the Americans just sending them a few more planes, American planes, and that's geopolitics for you at a high level. It's very simple. It's horse trading, a real horse trading. Matt and I were in Turkey a couple of weeks ago, and we were speaking there. And the interesting thing is, inflation, as you mentioned there, it's not 70% actually. The people told us there it's 100%. The real inflation is 100%. And normal people, of course, cannot cope. And they get adjusted once a year, normal people, their salaries. And of course, when prices go up, every month, 10% almost. But the wealthy, of course, they have no assets in Turkish lira. But if whoever has an export company or an export industry does very well in Turkey because of the low lira. But this is what happens in any country with a high inflation and a badly managed economy, and Turkey will suffer dramatically in coming years. But as you said, the BRICS countries, as also Matt talked about, and the sanctions that also necessitated for central banks to slowly get out of the dollar as reserves and into gold, but that's going to have a dramatic effect on the gold price in the coming, let's say, 5 years. It's not going to be a quick move. It's going to be a gradual move into gold from now dollar reserves only, basically, that central banks are holding. And the effect on that, on the gold market, we have discussed it before, but I want to stress that the effect is not a small move in the gold price. It's again another tectonic shift. And you're talking about gold going up by multiples over the next few years. This is not a sensational forecast. That is just the result of funds flowing from dollars, a sinking currency, in a bankrupt country, into the only money that's ever survived in history, gold. That move is going to happen. And it is absolutely guaranteed, Jan. It's the only way also for central banks to control actually the money and not having it, or their reserves, not having it confiscated by countries like the US, which is the only country that does confiscate it on a bigger scale. It'd be very, very interesting, this move, and of course the whole world will follow. BRIC countries will follow to buy gold, not just the central banks, and then investors will also jump on the bandwagon. So there will be a major move into gold. I hope it's not going to be dramatic in the short term. I hope it'll be slow and steady. But I think at some points it will probably accelerate, whether we want it or not. A market which is too overbought and too hot is not good. Which means there will be also major corrections at some point. But right now we're not looking at corrections at all. We're looking at this trends continuing before we see any major corrections.
We are still in the calm before the storm, but in a recent article, Matt showed an interesting graphic, because we talk with our focus about precious metals, of course, but also commodities, because I think this tectonic shift in the global world to a multipolar world is in favor for commodities in general. Let me show this graphic. This one here, I think it's a few years old, but commodities to equity ratio. And if we assume that sooner or later the US stock market will correct and commodities with the influence of less dollar usage and demand from development countries, this, I think, is on the way, as you correctly point out here, on the way up. But on the other hand, we have big risks now with this confrontation in the world. And therefore, I think, maybe you agree or not, that silver and gold will outpace those demand and those developments in other commodities by far.
That was a chart, Jan, that our good friend and advisor Ronnie Sturfula posted about a year and a half ago. And he said this could be the chart of the decade. And it was basically, this commodities to equity ratio is all-time highs right now in the S&P, and commodities are out of favor. These things are cyclical. There's a number of things to consider there. The first thing is, you've got to play where the ball is headed, not where it's sitting. And many investors just play for the next 30 seconds, not the next 10 years. Everyone says they buy at bottoms and sell at tops, but no one does. There's FOMO and there's chasing these markets. When they correct, paper assets will be less valuable, paper equities will be less valuable, and overpriced bonds will be less valuable, and real assets like commodities in general will do well. There'll be a super cycle. Can't time it, but you have to prepare for it. To your point, though, when the economy is in recession, commodities need, growth to be a valued asset. That said, again, there'll be periods where commodities will be out of favor, but at some point they will resurge, and you want to be ahead of that puck or ahead of that ball. The other issue, though, is precious metals are not typical commodities. They're monetary metals. So you have to distinguish copper from gold and silver, and you have to distinguish wheat, hay, and pork bellies from gold and silver, too. The simple fact is the precious metals are a separate category in the commodity space, and the precious metals will continue to rise regardless of the commodity cycle for the simple reason that fiat money will continue to be debased. Fiat money throughout history will be debased in order to monetize the extraordinary debts that the entire world is in, not just the US. We're well over 320 billion in global trillion in global debt, 320 trillion, 330 trillion, 338 trillion. The numbers are increasing dramatically each year. Again, there's no GDP and there's no productivity globally to cover that debt. So all countries with fiat money and fiat paper, including the US dollar, will debase. That is why gold and silver will rise exponentially, for the simple reason that debt has destroyed currencies. And so that super cycle that Ronnie talked about is certainly worth thinking about if you're a long-term investor in general, getting away from paper assets to real assets. But the gold and silver commodities, the precious metal, the monetary metals will be an entirely different chart. It already is an entirely different chart in every currency, including the Turkish lira, and certainly the US dollar. It's up and to the right, and that's only beginning. To Egon's point, there can be corrections if it grows too fast, but the direction and the trend is as obvious as a setting sun.
I have to come back to Turkey. Egon, you said a part of that already. There is maybe a solution, that's not a real solution, but one way that a state can go to make its debt burden a bit lighter. And what is Turkey doing? Here we see the key interest rates of the Turkish central bank. It is at 50%. And as Egon said, the inflation is much higher. Here they write 75%. Egon, you said it's in reality at 100%. What does that mean? It's similar to the 1920s in Weimar, Germany. I remember some history lessons at university. Hugo Stinnes built his empire on that fact. He took loans from the central bank, from other banks at a lower interest rate, knowing that the inflation would eat away the loan. I think this is a possibility that we should have in mind. The US, the Fed, the ECB, although they lowered recently, they might go a similar way. Maybe they do not lower the interest rates, or at least only one or twice, like they expected now for the US this year, but the inflation will pick up and be much higher than this. So they try on that way to lower their debt burden. What do you think? It's a way, possible way, but on the shoulders or on the back of the money holder, as always.
Well, no money printing country has ever prospered. No hyperinflationary country has ever prospered in history from high inflation and a debasing currency. So that is not a recipe for success. Here you're talking about Turkey as an example, and you're looking at savers who the official inflation, I think, is 60-something%, 65. We had actually when we were speaking at this conference, the finance minister was talking also. And of course, his projection was very clear and absolutely dead certain also that it would happen, according to him. That is that inflation is 65% this year, he said. Next year it'll be 50, and then it'll be 30, and then it'll be down to zero. That was his projection, like any finance minister would do in front of any gathering of people. Now, the fact is that if real inflation is actually, as the people were telling us, 100%, it means that if people even earn as much as 50% of their savings, but they're losing half of their basically their money by debasement or the negative real return, because interest rates being a lot lower than inflation. And that's the same in all Western countries. That's the same in the US. I mean, the official inflation, and Matt touched upon this, in most countries, also in the world, and especially in the West, inflation is a lot higher than the advertised inflation, which is a manipulated rate that suits the government and no one else. And therefore, what's the incentive to save? There's no incentive at all. If you study economics, you learn that investments equals savings, period. And if there's no savings, which there isn't in the Western world, or very little, a lot of savings in China, for example, been in Japan now, they've been eaten into that in Japan, but China is a nation where they save 20% of their income. But in the West, no one saves, they spend, as you indicated in the first slides about the credit card debt, etc. And therefore, you will get no real growth in Western countries. If you do, actually, if your savings are much lower than your investment, you can't get any growth. You can only so that growth is only financed by more debt. And that's why you can't get real growth. So it's a vicious circle now for the world, and it can only end in sadly, in my view, in a debt collapse. Whatever tricks they try in between, like central banks, digital currencies, or coming out with a dollar number 2, whatever it will be, they will not be able to hocus pocus away the actual debt. And coming back to gold and Turkey. So Turkey is a country where they also hold, they save in gold, but of course most people can't afford to. But nevertheless, just back, I looked at the chart before. Just back in 2017, there was 4,000 lira to an ounce of gold. Today it's 76,000 lira for an ounce of gold. So that's almost 20 times higher just since 2017. So this is the wonderful thing, that gold always reveals the absolutely idiotic management of the economy by governments. But that's why governments never like to talk about gold or the gold price, because, as I said, it's a truth teller. It's actually the only real money that exists. And but because governments don't want to talk about real money, because they want to talk about their pounds or their dollars or their euros, which are going down by the day. So that trend, as you said, we're going to continue to see that trend for falling currencies. Whoever gets first to the bottom doesn't get a prize anyway, and you get no prize for being number 2 either. So it doesn't matter if the dollar is what it comes third and rather than first to the bottom, because a lot of people talk about dollar being strong, the dollar being strong. It's true, but that's, as Matt said before, that's a relative game. We're not interested in the relative game. We're interested in the absolute game or game. And the absolute game is that all the currencies are now going to zero. They're already down 97, 99% since 1971. So that's going to happen. And that's why, we're not gold bugs, but we believe that savings in gold is definitely what people should do to whatever extent they can, or even silver. You get an ounce of silver for $30, or you get a small piece, a small gold coin for also a few $100s. And that's what people should look at rather than borrowing more money. And when you talk about loans, by the way, and people borrowing money and therefore making money by borrowing and assets going up faster, like they have done in hyperinflationary economies, the danger to that also that we could see a time when there'll be an indexation of the loans. I wouldn't be surprised. That's happened before in history and can happen again. And then you'll be wiped out, of course, if you have high borrowing. So it is not advisable to play that game, in my view. To be debt-free is much more important than to leverage yourself.
Definitely not an advice for Joe Sixpack, Egon, but I think some bigger entities in Turkey will use this. And I have a final table for today showing that what we are preaching here is right for over 20 years already. That's a table from our friend Ronny Stöferle since 2000, and with very few exceptions in all major currencies, gold is up nearly every year. And as we discussed, and as if we look around, can assume that will continue, and it will gaining pace. So I think with the geopolitical situation in mind, we can only advise to take precautions and put at least something or a bit more than usually into precious metals. A final statement by both of you, please.
Well, Matt or Jan, that graph is an important graph, or that table is an important table, although anybody who is a critic of gold will say that you start at the low. So it's a dangerous table to use because you're using, when it was down to 250 more or less. But nevertheless, and therefore, but Matt and I always talk about longer periods in history, and over time, even as we said, no currency has ever survived, and therefore that will be the case this time also. The world is heading in a very dangerous direction, and it is so sad that leaders, and especially Western leaders, and especially the US, and all the weak leaders in Europe in particular, and we saw how they were all losing in the recent European elections. Every single one is being pushed out. We're getting the worst leaders, which is really reflecting the times we are in. And so and now again they agreed to give the return on the Russian confiscated money to Ukraine. Why don't the leaders of the world get together to solve the real problems in the world, like the economy, the inflation, the real poor countries, rather than making war? The world is, especially the West, we're fighting about a small country here, which compared to the consequences of what can happen if this escalates, this crisis, which is a nuclear war. Why don't settle that little country, Ukraine, and some people have to give in order to solve that, and then actually world leaders get together and look at the real problems. The real problems are the world economy and what's happened to that, which we've been discussing here. It's not the Ukraine. But leaders always focus on a thing that can divert attention from what's happening in their own country and with their own economy, and then they can blame the war. And it's very sad. And I wish that people could or leaders could get together, because no individual in any country wants a war. Nobody. It's just the leaders who want a war for their own sake, because. As I said, they want to divert from the pressure of the economy. Anyway, that's I know that's a wish that will never be fulfilled, sadly. But this is what the world should do, rather than looking at rearming, which is happening now. So maybe not the statement you wanted, Jan, but I think it's a very important point here, that the world is sadly a world under pressure is focusing on totally the wrong thing, focusing on war rather than focusing on economic survival for the world. So that's my final point.
Yeah, and I'll just add to that from the American. Well, I totally agree, and it's totally grotesque. This was an entirely avoidable war, but it's not surprising. Hemingway in the U.S. famously said, "You'll always see political opportunists where their backs against a debt wall. They'll debase the currency and go to war. War can actually be good temporarily for GDP. We have a wartime debt. Might as well have a wartime economy. Since I was born, my country's either in a war directly or indirectly somewhere in the world. there was absolutely no doubt that the Ukraine war and the NATO issue was solvable before the first shots were fired. And there's absolutely no doubt that there was a concerted effort to avoid peace talks to this point. Again, not getting into the politics of Zelensky versus Putin. But for your German audience, they're quite familiar with von Clausewitz. And what did he say that war is? It's an extension of politics by another mean. But politics is just an extension of economics. Everything's about money. And when you have a country like the US, which once had its great moment post-World War II, with the help of Russia defeating fascism, etc., the flag on Iwo Jima, Hollywood, Clark Gable, all the great black and white images of a great America. We're not that country anymore. That's not an anti-patriotic thing to say. It's a very patriotic criticism to say. But we are now broke, and we are going to war intentionally to distract from our currency problems, our inflation problems, and our political divisions. And it is a von Clausewitz moment. We're just using war as an extension of politics. Politics is an extension of economics, and our economics is, again, donkeys leading us. So we are a military in a country of real lions being led by financial and military donkeys. And this was something that Eisenhower warned of in the early 60s before passing the torch to John Kennedy. Beware of the military industrial complex. When they take over policy, when they take over centralization of our foreign policy and domestic policy, and our central bank has taken over our financial policy. So between the central banks, between our military industrial complex, between our fourth estate, which completely betrayed the ideas of free speech and open, intelligent, as opposed to emotional and propaganda debate, the West is in very poor hands right now. And it's a very familiar scene. We've seen it before in other countries that are failing, and now it's happening in the land of the free and the home of the brave. It's quite sad for me as an American to watch, from whether I'm overseas or foot on the ground in the US.
Thank you for your final statements, Matt and Egon. People, we can only tell you, think for yourself, look at the history. It will not repeat, but it will be similar or even worse. Nevertheless, let's hope for the best and prepare for the worst. And precious metals should be a key in your preparations. That's for sure. Thank you, Egon and Matt, for today, and till next month. Thank you.
Thank you.
Bye-bye.
Thank you.
Thank you, Jan. Thank you very much.